But let's focus on the auto sector. A recent Elara capital note says that the post-GST reforms, all auto segments have seen acceleration in growth and strong growth momentum continues. Jay Kale, Executive Vice President Research at Elara Capital, joins us on the show. Hi Jay, good morning. Wishing you a cracker of 2026 and first among many conversations that we'll have during the course of the year. Jay, before we get to those findings of your report, I wanted to ask you about Maruti. Yesterday, the street got a little bit spooked. Suddenly, the stock lost its way. And there was that buzz that maybe, in fact, margins are getting compressed. They'll have the benefit of operating leverage, right? What are you working with in terms of expectations on Maruti's numbers? And also, if you could tell us, have you heard anything? What was the concern?
Yeah, good morning and wish you a very happy new year. So I think, see, Maruti, operating leverage has been pretty strong for the company in Q3, very strong volume growth. On a YOY basis, we see very strong ASP growth as well, double-digit ASP growth and double-digit volume growth. 17-18% volume growth we've already crossed. Of course, these are the positives. There have been some headwinds in terms of commodities as well. So there are pulls and pushes. Operating leverage is a positive. Commodities is a negative. Some bit of exports contribution going down will also have a bearing on ASPs. So with all these pulls and pushes, our margin expectation for Maruti is at close to 100 basis points increase from Q2 to Q3 on a sequential basis. That's our expectation. Of course, some bit of profit booking would have been seen yesterday. It has been a stellar run, since last few months post GST. And I would just guess that it was just a one-off day. But we would remain positive on the stock.
Sorry, for Maruti, what is your EBIT margin expectation for Q3?
So Q3, our EBIT margin expectations are around 9.2%, which was 8.1% in Q.
Okay, so you're at 9.2%. But this commodity cost inflation, I was just reading an HSBC note, and they're saying for two-wheelers, the commodity index is up 6.6% quarter on quarter. 7.8% up quarter-on-quarter for two-wheelers. For four-wheelers, it's up 3.8% on a quarter-on-quarter basis, which means an adverse impact on gross margins. For EVs, lithium carbonate prices are up 10% on a sequential basis. So elaborate a little bit more, because it's not just in Q3. In Q2 also, prices went up, commodities. How much will they be able to pass on? And is that a real headwind which can cap valuations?
I think commodities definitely is a headwind. But point is, we've seen that during the Russia-Ukraine war time when commodities had also spiked. You will get a quarter or two kind of an impact on commodities, on margins because of the commodity increase. Key over here is we need to see how demand momentum sustains. Because if demand momentum sustains, then you will expect companies to pass this raw material pressure in terms of price increases or discounts reduction in 1 or 2 quarters later. So yes, quarterly variations in margin will be seen. But if I have to see FY27 as a whole, if we are expecting demand momentum to be strong, then in that case, we believe that these raw material headwinds will largely be passed on to the customers. And there may not be that much of an impact on the EBITDA per vehicle or EBITDA margin as such. Operating leverage is the key thing to watch out for.
Okay, so since demand is the key, and you're saying FY27 will also see good growth numbers, can you tell us what will FY27 growth look like vis-a-vis FY26 for the key players? Is there an acceleration?
Yes, for key segments, I'll talk about what we are penciling in for two-wheeler and passenger vehicles. We're penciling in at close to 9 to 10% or growth in FY27. For M&HCVs and LCV, M&HCVs we are penciling in a 6 to 7% growth, and LCVs we are penciling in a 10 to 11% growth. So that's a broader call on the segment growth for FY27. FY26 itself has seen kind of a 2 times upgrade in terms of volume growth. We started off passenger vehicles with the year at 1 to 2%, which then moved to 5 to 6%, and it has moved up further to 8 to 9%. So clearly, demand momentum post the GST cut has held up well, even post festive season. Q4 also, the sentiments and the dealer sentiments, the channel check suggests that it is healthy. Of course, it will moderate from the kind of growth that we've seen in the festive season. but still a high single-digit growth is definitely possible in Q4 for various segments. Commercial vehicles in Q4, of course, will be a strong double-digit growth in our view. But the other sectors holding up will be favorable for overall valuations also.
All right, Jay, on a personal basis, I was wondering whether Royal Enfield is coming out with the new motorbike. I reached out to the team not to ask about anything with regard to the stock, not, with regard to anything on the production capacity, but just are they coming out with the new bike? They told me no, at least for this year. There's no heavier variant that's coming in there. So I went ahead and just changed my tires yesterday after 7 years. That said, what's the view on Eicher Motors? The GST cuts seem to have spurred volumes yet again for the 350cc, it appears so. And they are continuing with that momentum. Valuation's not very cheap, but it appears that they have a bit of a runway from here on as well. Your view on the stock?
Absolutely. I think you can see a year back, say October 2024, when they took that price cut for Bullet variant, that's when the volumes propelled. But if you see Q3 FY25 to Q1 FY26, well, volume growth was 18%, the EBITDA growth was just about 8%. Come GST cut, and they've got a price cut even on their largest selling model, which is the classic 350. And those volumes have also revived now, as we speak, even until December forward. I think that momentum is expected to continue. And now suddenly we are going to see earlier where EBITDA growth was lagging volume growth. Now EBITDA growth will start outperforming volume growth. And that will be the key trigger for the stock to re-rate going forward as well. Volume growth has sustained even up till December, and probably in Q4 also we are expecting strong double-digit volume growth for Royal Enfield. And with the EBITDA growth also outperforming that, I think valuation re-rating is on the cards. And we have a buy rating in the stock with a target price of 9,000.
Thank you very much for joining in, Jay. And just for our viewers, his top picks are Maruti, M&M, Eicher Motors, and TVS Motors. Thank you very much for joining in.